So about India's structural growth rate. So when we think about investing in India today, so it's important to look beyond short-term market movements and then focus on the country's long-term structural growth story. Right? So when we look at the growth story, it is being driven by sort of multiple structural pillars that are coming together, starting from rising domestic consumption, be it manufacturing and capex revival or formalization of the economy and supportive policy reforms, right? So when we look at the last decade, so India has transformed from being a consumption-led economy into a more balanced economy where manufacturing, infrastructure, exports, financial services, which are all contributing to growth, right? So this diversification makes the economy more resilient, creating multiple opportunities for the investors to explore. So when we look at the chart, so what we can see is that India's nominal GDP growth has nearly doubled, right, from $2.1 trillion from in FY15 to approximately $4.1 trillion in FY25, right? So what this highlights is it's the strong pace of India's economic expansion over the past decade, with structural drivers, that are also expected to remain firmly in place as we continue to go forward as well, right? So now what we have done here is that we have projected, let's say, taking a base case projection of, let's say, 8.8% CAGR. The economy is expected to grow to reach somewhere around $9.6 trillion by FY35. Now, this is just a base case scenario. Now, when we consider, let's say, a stronger productivity coming in, expansion in manufacturing, and then, let's say, continued reforms, this could even further surpass to, let's say, crossing the 10 trillion mark, which is a milestone that we are aiming as of FY35, right? So this sustained economic growth, coupled with rising per capita income, which typically leads to, like higher consumption, greater financialization and increased demand for, let's say, housing, credit, travel, and premium goods. So what it does is it drives sustained earnings growth across sectors, leading to multiple high growth segments, right? Which has the potential to generate around 1.7 to $2 trillion revenues, let's say by 2030, which can contribute to roughly, I think, 30% of India's incremental GDP, right, by 2040. Yeah. So moving on to the next slide. So about the current macro environment, right? So before we talk about the investment opportunities, it is important to understand where as an economy we stand today, right? So, despite global heightened global uncertainty, we're seeing that India's economic fundamentals continue to remain resilient, right? When we look at the real GDP, if you see, it has grown somewhere by 7.7% in FY26. Accelerating some from 7.1% in FY25, right? So which makes us one of the fastest growing major economies globally, right? While this growth has remained robust, the macroeconomic stability has also been equally encouraging. When we look at inflation rate, it is continues to remain well under control. So if you look at the CPI data, so it has risen to 3.9% in the month of May from 3.5%, right? Which continues to be below RBI's medium threshold of 4% or between the range of 2 to 6%, right? So this macro favorable backdrop is also additionally reflected in when we look at the high frequency business activity indicators, right? Which continue to signal strong economic momentum. So when we look at PMI manufacturing, the print has come in at let's say 55 in the month of May, which is above the previous reading of, let's say, 54.7. So what it does is it indicates that the sector growth has accelerated to a 3-month high, driven by, let's say, demand, despite facing this inflationary pressures, right? On the other hand, we are also seeing that services reading is also improving, touching a 6-month high of 59.8. which is boosted by once again healthy demand conditions and ongoing improvement in the new business intake. So supporting these encouraging indicators, tax collections have also remained very robust, reflecting the healthy consumption and economic activity. So when we look at GST collections, it had hit a record high of 2.43 lakh crore in the month of April, and in the subsequent month, it has come down slightly, but it remains strong at. And for the month of May, it has come in at 1.94 lakh crore, right, which supports the healthy economic activity that we are highlighting. Furthermore, when we are looking at also in the month of June. So RBI had its meeting. So where it had turned its focus towards preserving growth amidst this global uncertainty, keeping this repo rates unchanged at 5.25%, right? So more importantly, the RBI and the government they together announced several measures which it seemed to attract foreign capital. To strengthen the external stability, right? Some of these initiatives, include supporting for NRI deposits or let's say foreign currency funding and even debt market participation. This has the potential to bring in about capital inflows of somewhere around the north of 75 to 80 billion dollars, right? So all this also improves the outlook for the currency, which has been one of the major concerns for domestic investors or uh, the past year and a half or so. So while we do not expect, let's say, sharp appreciation, we are seeing that, like we are expecting greater currency stability going forward, supported by, let's say, stronger capital inflows once again due to the measures taken and even robust macro fundamentals that some of which are violated, right? So a more stable rupee, what it shows, it is a positive for equity markets as it also enhances the USD returns for foreign investors, right? As let's say, it supports the FII inflows, which also eases imported inflation and which creates, once again, a favorable backdrop for even corporate earnings and long-term market performance, right? Of course, while stable rupee is supportive, its sustainability will also depend on one of India's most important external variable, right, which continues to be crude oil prices, which we tend to be very vulnerable. So when the higher oil prices, so what happens is it remains the single biggest external risk that impacts inflation and even current account deficit, and also impacts the currency, right? So since the tensions or the war started in the West Asia, let's say in the month of March 26, what I observed is the Brent crude had briefly surged uh, to around 118 US dollars per barrel in month of April. Uh, uh, but then since then it has corrected by nearly 37% to around 75 US dollars per barrel as of yesterday, as the concerns around the geopolitics or let's say or the shipping through the Strait of Hormuz started easing and which is also expected to further normalize, right? Um, so although oil prices may not immediately return to pre-conflict levels, a sharp correction it significantly reduces the inflationary pressures that we were concerned about for the past 2 3 months, and it improves the India's external position, right? As of now. Yeah. Yeah, moving on to the next slide now. So talking about the currency, so one of the biggest worries is that like whether foreign institutional investors are will return to India, and like what we have seen is over the past 18 months, the FIF flows have remained subdued, mainly due to a combination of elevated US interest rates, or be it a stronger US dollar, the uncertainty around the geopolitics, or opportunities in the AI-driven markets, such as US, Taiwan, and Japan and South Korea, right? So, amongst this, one other key reason that we have seen is that the global interest rate environment, which had continued to favor developed markets right over emerging markets has also been a key reason. So when we look at global bond yields, so it has been pushed to sort of multi-year highs in the month of May, mostly led by sort of war-driven energy prices, which fuel the bets around that, like Federal Bank or be it other central banks around the world may end up raising interest rates to tackle the, let's say, liquidity or the inflation risk that arises in their economy due to this uncertainty, right? Now coming to India and US, when we look at as per the chart, when you look at the India-US 10-year yield spread, so what we can see that uh, it has narrowed significantly over the past few years, right? As the let's say as the U.S. Treasury yields rose sharply due to, let's say, aggressive Federal Reserve tightening, while the bond yields sort of remained stable for India, which is supported by mostly moderating inflation and fiscal management rate. So when we look historically, so the 10-year yield spread, it was around approximately 450 to sort of 550 basis points, which compensated the investors for, let's say, for India's sovereign risk, or be it the higher inflation, or even including the currency depreciation, which was on an average around 300 basis points, 340 basis points, right? So however, what has happened is subsequently now the spread has compressed to around 250 basis points, somewhere from 550 basis points, which has narrowed the relative yield advantage that the Indian fixed income assets were benefiting from. Or no, this thing is, I have not even considered the currency depreciation right now. Let's say if you adjust that for, let's say, average annual INR depreciation of 340 basis points, what happens is the nominal yield premium itself effectively turns from a premium of 250 basis points to a discount of 150 basis points, right? So furthermore, I have considered only average. So when we look at the actual depreciation in the year of 2025, it has been around 480 basis points, and in current year YTD basis, it is around 500 basis points. So which makes the effective return for the foreign investors very unattractive. So that is one of the reasons why the outflows have also been very sharp that we have observed over the past 2 years, and the other one being that AI related capital rotation that had occurred. Right? So the weakness in the rupee, so partly it reflects the adjustments after a prolonged period of, let's say, RBI currency stability that had happened, which also makes the depreciation that had occurred in the last year and the current year appear very sharper than it actually is. So what we are expecting is, as the rupee stabilizes and this interest rate differential normalizes, the relative attractiveness towards India will likely improve. This supports the renewed foreign capital inflows into both equity and the debt markets, right? So the outlook for, when we look at the outlook for FII flows, so we are not expecting like a very sharp reversal. So what we are seeing is it is gradually becoming more constructive also, and considering that currently in equities, FII ownership is low, somewhere around 16%, I think, and considering the strong macro fundamentals of the economy, and even recent, let's say, RBI and government measures, which are expected to attract more foreign capital. Along with this, we feel that it provides a supportive backdrop for a renewed foreign inflows and a stabilizing currency environment, right? Yeah. Yeah. Moving on to the next slide. So one of the disconnects between market weights and earning pairs, what we're observing is that Indian markets are currently being sort of neglected because capital is becoming more selective, as every emerging allocator is looking for the most earnings growth, and And this distinction sort of sits at the center as what has happened in the emerging market allocation over the last year, right? When you look at the table, there's a clear evidence of rotation in India's weight itself. If you see that India's weight has fallen from somewhere from 19.4% in Q4 of 2024 to 11.2% as of May 2026, right? Compared to that, Korean and Taiwanese equities outperformed Indian markets in triple digit margins, even in the dollar terms. So their weight compound, and so do the passive flows that, they follow this increase in allocation, and end up reinforcing this active rotation, until it reaches sort of an extreme rate. So when do we see these extremes happening and all those things? Now, when we're preaching about earnings growth, so domestically, what we're seeing is, after a 6 quarter, I think FY25 mid-cycle slowdown, we are seeing that it's just starting to accelerate further, right? Being driven by, let's say, rate cuts or liquidity infusion, the tax cut that have occurred, the strong capex trends that we have seen in energy, defense, semiconductors, and data centers, right, amongst others. So all this together, what we're seeing is the headwinds that had made investors sort of cautious about the market have now largely eased. Uh, uh, when we also look at the trade agreements that we have taken over the past year, like, let's say, along with the US and the Europe, also we are improving relations with China. So all this further strengthens the outlook. So as of now, additionally, the currency is also being undervalued. So on a real effective basis, and the domestic equity flows, what we have observed, is also been stronger. That is partially one of the reasons why, despite the FII outflows, that the markets have been very resilient and not seen a very sharp fall rate. So the other thing that we have seen is also, when we look at the trailing 12-month relative performance of Indian markets compared to its global peers, so it is amongst the worst in the history that we have seen. And but when we see from the valuation front, so what we're seeing is valuation are close to previous troughs, and the positioning by FIIs in the domestic markets are near multi-year lows, right? So what it positions is, it gives an opportunity. It sets a stage for us, for the domestic markets, to outperform in the subsequent years, as all these headwinds start to fade away, right? So now, when we look at the chart on the right, so what it shows is that, like, India's share of global profits, it exceeds its weight, global weight, by the highest margin ever, right? So the spread, let's say, is currently greater than 1%, which suggests that, that India is structurally under-owned compared to its earnings power. So essentially, so we are a firm believer saying that, like, our long term price will always tend to follow earnings growth, right? So when what happens, when we are being under-owned and earnings keep compounding, eventually it sets a stage for subsequent outperformance, right? So as long as the earnings continue to compound, and when the foreign ownership normalizes, India's weight in the index would gradually move closer to its profits, global share of global profits, right? So over the long term, what happens is, this sets a stage for, once again, like I said, that outperformance once again reinforces the passive inflows, and it continues to see more additional inflows over time, right? Yeah. Yeah. Moving to the next slide. Yeah. Talking about in the savings-led capital formation, right? So what we're seeing is the long-term investment opportunity is sort of underpinned by structural trend that is extending beyond the current market cycle. So what we're observing is a rapid growth in the domestic savings, right? So what happens is, as household income rises, the financial, let's say, inclusion deepens, and let's say the working age population continue to expand, the country's saving pool would likely sort of increase very dramatically over the next decade or so. So what does this saving do is it provides the capital that is needed to, let's say, to finance your infrastructure projects, or let's say manufacturing, or housing, and corporate investments, right? So this creates a virtuous cycle of, let's say, higher investment, stronger economic growth, and corporate profitability, right? So this sets a foundation for India's next capital formation cycle. So when we look at between the year of 2010 to 2025 and 2025, India has generated approximately around $12.7 trillion in cumulative gross domestic savings, right? Now, when we look at the next 15 years, so what we're expecting is between 2026 to 2040, this cumulative savings is projected to rise to nearly $37 trillion, right, which is almost three times the previous 15-year period. So this reflects not just the strong economic growth, but structural increase in the country's capacity to sort of generate investable capital. Importantly, what it also sets is the nature of the savings is also becoming visibly changing, right? So which we look at in the next slide. So when we look at India's wealth management landscape, what we're seeing is it is going in undergoing a structural transformation. So as the household income rises and let's say financial literacy improves, investors are sort of moving beyond their traditional bank deposits and increasingly allocating their capital towards, let's say, professionally managed financial products, which are essentially high yielding financial assets, right? So this shift towards this assets is one of the strongest long term themes that we are observing in the India's capital markets. Now, this the mutual fund industry's assets under management, now when you see, it has grown much faster than the bank deposits. Um, Rising from, let's say, 12.6% in 2015 to about 29.5% in 2026, right? Which is more than double in just over a decade. So demonstrates that, there's ongoing financialization of the household savings that is happening. However, this evolution does not just stop with mutual funds. So as an investor, as the wealth increases, so do their investment requirements. Now, when we look at high net worth investors, so they're increasingly seeking, let's say, differentiated strategies with greater portfolio flexibility, right? So they're looking for to access for opportunities beyond the traditional products, which is sort of like driving the rapid adaptation of AIF that we are seeing right now. When we look at uh, uh, between FY21 and FY25, the AIF industry's share of India's managed assets that's increased somewhere from 4.1% to 6.9%. So it makes it makes the asset category as one of the fastest growing during this period, right? This reflects growing investor preferences for specialized investment solutions that complement traditional portfolios through, let's say, being concentrated ideas or even flexible mandates or differentiated return drivers, right? So this structural shift is sort of creating a favorable backdrop for AIFs. So when we're talking about AIFs, so essentially what they is a it's sort of a SEBI registered, so privately pooled investment vehicles, let's say, for high net worth individuals with a minimum investment requirement of about 1 CR. So it offers, let's say, greater flexibility in terms of portfolio construction, which also enables the fund managers to pursue uh, high conviction investment strategies, right? Yeah, moving to the next slide. Yeah. Uh, um, so to participate in, let's say, in India's long-term structural growth story, so we have recently launched the RH Rising India Opportunities AIF fund, which is a SEBI-registered Cat 3 close-ended AIF, which is focused mainly on, let's say, listed equities. Here, the strategy is focused on multi-cap with a sort of a deliberate bias to the small and mid caps, right? So what we believe is that India's next phase of wealth creation will come from identifying emerging market leaders across the market caps, right? So this flexibility to dynamically allocate between large, mid, and small cap, it allows us to capture opportunities across market cycles, while maintaining a sort of a disciplined risk framework, right? Uh, more specifically towards the fund. The fund has a 6-year investment horizon with a minimum commitment of 1 year, and the drawdown structure is we're looking for a phased drawdown structure over 24 months, right? So it is designed to sort of align the investor capital with sort of long-term investment approach rather than looking at short-term, right? So the strategy is built around the India's long-term structural growth story, but also driven by themes such as, let's say, manufacturing, consumption, financialization, healthcare, which we will look for towards the end of the presentation, right? So how do we do this? Is that we follow a bottom-up research process with the proprietary RH multi-bagger framework, right? So where we identify high-quality businesses, primarily in the mid and small cap space, wherein we are looking for companies which have the potential to deliver earnings growth, double their earnings growth over the next 3 to 5 years, right? Uh, yeah. So ultimately, the objective is, the long-term wealth creation, and especially through disciplined portfolio construction, by managing through, let's say, active stock selection and prudent risk management, while also participating in the growth journey, right? Yeah. Now, moving on to the next slide. So one of the concerns would be that the realities is that investing in the mid and small cap space is that they offer superior long term growth potential, but they also experience sort of greater volatility. Now, rather than sort of avoiding this volatility, so our aim is sort of to manage it actively, right? Through this AIF fund that we have launched. So what happens is, let's say, as the Cat 3 AIF, uh, so we are able to selectively use derivatives for hedging, right? Let's say during periods of heightened uncertainty that we observed, as we saw in the last in the month of March or something. So what happens is, let's say, hedge typically costs us around, let's say, 2 to 3% per annum. Uh, what we are not looking to deploy it continuously, sort of, and only manage it selectively. So the other thing is that, like, we have also done our scenario analysis where what happens in case let's say the market sharply falls down by, let's say, 25%, right? So what happens when we do the hedging, right? So the hedging is able to reduce the portfolio fall to, let's say, around 15%, while it doesn't, let's say, neutralize it completely. That's what it also lowers the amount of fall, which creates once again alpha on the bottom side as well, right? So by combining this dynamic asset allocation along with this selective hedging, our objective is to participate in the long-term market upside, while delivering a smoother sort of investment journey and better risk-adjusted returns across the market cycles, right? Yeah. More to the next slide. So more specifically towards the small cap cycles, right? So understanding more about small caps. So they've historically been sort of India's long-term wealth creators, like, but they have moved in sort of well-defined cycles. So when we look at the past decades, see every major correction that you can see, it has eventually been followed by a very sharp, strong recovery that sort of creates attractive opportunities for disciplined long-term investors. No, as a research or analysis, it shows that the average correction is here we have only considered falls about 20%, right? Falls So the average correction has been around 37%, while the subsequent recovery post that has been approximately 221% in absolute terms, right? So with up cycles, which typically last somewhere 22 to 47 months. So this outperformance is supported by sort of strong fundamentals and not by speculation, right? So when we look at the last 20 years, what we're seeing is mid companies sort of delivered earnings CAGR of 18.7%, compared to 10.4% for the Nifty 50, which reflects the superior growth potential of emerging businesses compared to sort of mature businesses in the large cap space, right? At the same time, so what happens is fewer than 300 companies out of, let's say, India's 5,000 plus listed companies receive meaningful institutional research coverage. So this creates opportunities for us to, let's say, discover high quality emerging businesses before they become widely owned and sort of experience a valuation re-rating, right? Moving on to the next slide. More on to the small cap spread within the historical bands, right? So when we look at on a FY27 till date basis, so small caps have sort of gained around 29%. They outperform the mid caps at which have come in at 17%, and large caps at only 7%, right? So this recovery has been mostly driven by sort of improving sentiment following the easing around the geopolitical tensions, especially around the West Asia conflicts, and also that there's the healthy Q4 numbers that are coming in, and subsequently moderating in crude oil prices. All this contributed for the small caps to sort of outperform, right? This has been a very sort of strong rebound. This outperformance of small caps, over large caps. It shows that small to large cap return spread continue. It's still near its long term average, right? Which shows that this enough headroom for it to outperform rather than being at extreme levels. So our what happened? Our tactical allocation framework, which is based on, let's say, historical return spreads between the small cap and large cap. It shows that the average spread is roughly around 8% with, and when you look at the plus one standard deviation, it is around 37%, and the plus two standard deviation comes around at 54%, right? So when the spread approaches 37% sort of outperformance, what we will do is we will gradually increase our allocation to especially large cap companies, and then even subsequently, as it moves further, let's say we will selectively sort of lock in profits, right? And let's say when as valuations tend to become even more richer, and the spread approaches the plus two levels of to north of 54%, which it indicates there's extreme optimism that is coming in, and there's a little bit of correction risk that we can expect. So at which time we will selectively sort of deploy the hedging strategies which I had highlighted previously. So in order to protect or let's say lock in some of the profits and that have occurred, and protect the portfolio from while we remain invested, right? Similarly, like when this, let's say, the spread, let's say, falls down to 20% also, which it would reflect, excessive pessimism, wherein we can increase sort of exposure to sort of high quality small cap businesses in order to capture the next phase of recovery, right? So this disciplined framework enables us to participate in long-term upside while actively managing the downside risk, right, across the market cycles. Yeah, moving on to the next slide. So what we've seen is, like, after it's sort of a challenging FY25, where we saw like there's a weak revenue growth and even margin compression. The small cap earnings cycle has once again strengthened meaningfully from FY26 onwards, right? With sort of, you can see broad-based improvement not only across profit but also across revenue, operating profits and the PAT growth rate. So this recovery sort of is being supported by domestic demand, by operating leverage and easing cost pressures, right? Which increases the likelihood of earnings-led re-rating, and partially one of the reasons why we have seen the small caps, let's say, rally around 29% since the financial year start, right? Yeah. Yeah, moving on to the next slide. Uh, so what we've seen is history shows that the small caps sort of often go through a very periods of consolidation before they deliver their sort of the strongest phase of returns, right? So so after a prolonged consolidation, what we observed in 2021 and 2023, so we have seen that like small cap index is sort of rallied by more than 2.1x as the earnings accelerated, or let's say as the confidence returned for the investors, right? Similarly, recently after the peak level in December 2024. Sort of small caps have corrected by around 26%, by bottoming out in the month of March of 2025. But since then, what we have seen is they have rebounded by around 30%, sort of outperforming both mid caps and large caps, right? Which highlights that that market. Leadership sort of typically shifts back to small caps once the uncertainty begins to ease, right? Now this outperformance sort of is not just an isolated event. Now when we look at periods of, let's say, FY 2004 to FY 26, you can see that like small caps have ranked as the one of the best performing market cap segment in the 11 financial years out of 23, compared to 7 for large caps and 5 for mid caps, right? So even today, when you look at the 1 year rolling return for small cap, it stands at around 25% ahead of mid caps, which is at 21.4%, and for large caps being at 16%, right? So what is encouraging is that this recovery is now being supported by sort of improving fundamentals rather than just sentiment, right? Now as corporate earnings starts to strengthen, and as the headwinds start to fade away, and along with the supportive sort of policy measures announced by RBI and the government, which is also expected to improve liquidity and attract more foreign capital inflow. So this sets the stage for the markets to perform favorably in the future, right? Yeah. So moving on to the next slide. So regarding the RH multi-bagger framework, so at the heart of our investment philosophy is RH multi-bagger framework. So what we believe is the long-term wealth creation. It comes from owning businesses that can consistently compound earnings, right? So the framework is built around two pillars. So one being growth. Now when we look at businesses, what we are seeing for is companies that can double their earnings growth over next 3 to 5 years, right? Which is supported by structural tailwinds, and let's say these companies are willing to increase the market share, or let's say they have very scalable business models and high quality management, right? The other one, what we're looking for is valuation. So even though sometimes the businesses are of high quality, they may not turn out to be a good investment, like if you end up purchasing at high prices, right? So we therefore want to invest when valuation sort of it provides a reasonable margin of safety, and offers a sort of potential for multiple re-rating, as the earnings continue to compound. Now, so when we combine these two, what it does is it leads to creating sort of multi-bagger returns. For example, what I can say is, let's take a consumer fashion retail company. Now, let's say it's trading at 30x EV by EBITDA, and its sector multiple is at 50x. So it offers a discount of around 40%, which is roughly 1.6x. Now, when we expect the earnings to double, which is 2x, so both put together over time, we expect it to contribute around 3.3x sort of returns, right? Yeah, moving on to the next slide. So what our research-led framework, it has consistently sort of identified businesses that have delivered significant long-term wealth creation, right? So here we have captured some of the past and current investments that have generated multi-bagger returns, demonstrating the power of sort of disciplined stock selection and maybe long-term investing, right? Yeah, moving on to the last slide, mm, uh, on the portfolio themes for the next bull cycle, right? So these are all the long-term structural themes that we think align with India's journey towards this $10 trillion economy. So our focus is on identifying these high-quality businesses sort of within these sectors with tailwinds that can deliver sort of sustained earnings growth and create some sort of long-term shareholder value, right? Starting with, let's say, wealth management. Uh, when we look at, so it is supported by India's financialization with only 15% of financial wealth currently being professionally managed right now. When you compare this against developed markets, which is roughly 75%, so this offers a huge potential for growth over time, right? Similarly, is the case across healthcare as well. So. What happens is now India currently has, let's say, 1.3 hospital beds per 1,000 people, right? Which is well below WHO's sort of recommended 3 beds per 1,000 people, right? So this offers once again a very good growth potential for the next decade, right? Uh, Similarly, so we also remain positive on, let's say, consumer discretionary, where we are seeing that the apparel market is sort of expected to nearly doubles from 5.5 lakh crore in FY23 to over 10.6 lakh crore by FY27, right? Additionally, the other one being renewable energy. So I think the government is targeting of around 500 gigawatts of renewable capacity by 2030. Well, now we are currently standing, I think as of March 26, we are at 284 gigawatts, right? So this offers the huge potential to grow over the next sort of decade, and we are looking for companies within these sectors with structural tailwinds, so that they can grow above the industry and subsequently create value for us, right? Um, so, so as we sort of conclude, some of the few key thoughts that I have is like, let's say, despite let's say near-term uncertainty, let's say from geopolitics or even global macro risks, India's long-term investment story sort of remains firmly intact, which is supported by all the structural drivers, right? So in this environment, this portfolio construction is just as important as stock selection, right? So the ability to sort of dynamically allocate across market cap and sort of even selectively edge during, let's say, periods of heightened uncertainty, it helps improve risk-adjusted returns while still continuing to remain invested for the long term, right? So that is the thought process behind our RH Rising India Opportunities AIF fund launch, right? So thank you for your time and participation today. So we hope this session sort of has provided useful insights into the current market environment and the opportunities that India presents for the long term.